that God ever created, and I mean that. The jobs are coming pouring back. Factories are coming pouring back into our country. We're going to build our steel industry back, and we're going to build our aluminum industry back. The steel folks are going to be very happy. We will cancel the job-killing restrictions on the production of American energy, including shale, oil, natural gas, and clean coal. For those miners, get ready because you're going to be working your asses off. And we will also create more jobs in infrastructure, trucking, and manufacturing. To make such an incredible investment, Chairman Go put his faith and confidence in the future of the American economy. In other words, if I didn't get elected, he definitely would not be spending $10 billion.
That last reference was a Foxconn, actually, the plant that they were going to build in Wisconsin. They're not so much anymore. Okay, on this Jobs Day, it's a good time to take stock on how the president's policies are actually working. Still with us is Megan Green of Manulife Asset Management. Megan, let's start with steel. The president referred to steel. We'll put up a chart here that shows actually what's happened with steel employment coming down. On the right, what that is how many hours you need per ton of steel to produce it, which sort of explains maybe what's on the left.
Yeah, that's right. So we have seen this in the past couple of months of data that fabricated metals, auto workers, those jobs have actually fallen, which is what the economic theory suggests should happen when prices go up and, some firms go to other markets for this stuff. So it's behaving exactly as we expect, but certainly not as Trump had suggested.
Right, because the idea is because you had the tariffs, therefore the raw materials for U.S. producers wind up going up, and therefore they can't necessarily pay their workers or they need to cut back. I mean, so ironically, what was supposed to help them didn't quite pan out that way.
That's right, or they go to other countries for steel. They just avoid the U.S. altogether, in which case we don't need as many workers. So what we've discovered is it shows up in the jobs data as economic theory would suggest, but with a significant lag. It's taken a while to finally show up.
So maybe not steel. How about coal? How are we doing in coal? A lot of miners going back and down to the mines?
Yeah, nope. As it turns out, no. And part of that is a supply and demand question, as well as we're turning away from coal towards other sources of energy. Tariffs aren't going to address that at all. That's an unstoppable trend.
What was interesting, is it some of the rhetoric over the last couple of days when you had some a natural gas couldn't get out of the ground because it was stuck in storage. It was so cold that could actually strengthen the whole nuclear coal conversation because you needed it as a backstop. If the freeze sort of affected natural gas, auto companies couldn't work as much in Michigan. See, Michigan.
So, it's all about Michigan, but also it's all about weather, according to Megan. So once again, the weather explains what's going on.
But that's not going to, you're not going to have a huge job turnaround. But the point is that there's going to have a little fodder for that conversation.
So in fairness to the president, manufacturing, he says we're manufacturing jobs back, and we'll take a look at a chart that suggests they have come back a bit.
They have come back a little bit. Now, it's not clear that that's a reflection of tariffs so much as a reflection of economic reflation. You can see in the chart that this started before Trump came into power, actually. So it's a continued trend rather than a new one based on new policies.
Ironically, not so much in the Rust Belt. Actually, the Rust Belt jobs in Michigan, Ohio, they have not come back as fast.
That's right, and we've seen this with things like GM plant closures, right? So we are seeing that in certain areas of the country. But I would argue again that this isn't actually based on policy. This is just a continuing trend.
Well, interesting though, if we wind up having any resolution with tariffs, if farmers wind up feeling better, I know that was more like an auto plant conversation. But if farmers feel better, if they have more money, they can sell their goods. Is that kind of change? I don't know.
So you might get a slight boost to the economy if there's some kind of détente on trade for a little while.
But on farmers, it's because we took it down. So it'll come back up from where it went down, right?
Right,
it's gone down. As you point out, soybeans, for example, we have been shipping a lot of soybeans.
Right.
So if we start shipping them again, that'll be a good thing.
Well, that's what I'm saying. Maybe they'll pick up, but I don't know how much that will translate into employment.
And we saw this before the tariffs. There was a massive front running of the tariffs, and GDP growth hit an absolute peak. So it should have some impact on growth and therefore employment. But you're right, it will be coming back from low.
But in fairness, he wanted to create jobs, and they've created a lot of jobs in the Trump administration. There's no denying that.
There's no denying that, but I would argue that other administrations have also created a lot of jobs. So this is partly a reflection of underlying economic strength more than actual policies.
All right, hang tight, Megan Green, Manulife Asset Management. We're just about 1 minute and 10 seconds away from the jobs number. Let's take a quick check-in here on where the markets are. So you have earnings coming in. Best start to the year for the S&P since 87. Yeah, today a little bit of softness. You have S&P futures down by 0.5%. European banks, one of the losers over over in Europe. Deutsche Bank coming in, their fixed income revenue just did not hold up, particularly when it comes to its peers in the U.S. In other asset classes here, a lot of eco data coming in Europe as well. Euro dollar up by 0.2%. You had a slowing in overall inflation, though core wound up picking up, but PMI is disastrous kind of anywhere where you look, and you can really see that play out in BTPs. A lot of selling in the bond market over in Italy, yields up by 17 basis points. The sell-off continues, and 2-10 spread continues to flatten just a teeny tiny bit. It was really about the bull steepener after the Fed. What will happen when the jobs number comes out? And crude down by 0.5%. All eyes there on Venezuela after its best month on record. We're just about 15 seconds away from the all-important jobs report. Non-farm payroll is expected to come in at 165,000 jobs, with the U3 rate holding steady at 3.9%. Now we turn to Bloomberg's Michael McKee, who's live at the Labor Department. Mike?
Very little impact from the government shutdown. Unemployment does tick up to 4%. 304,000 jobs created in January, but hold the champagne on that one. December's blowout job numbers were substantially revised lower to 222,000 from the initially reported 312,000. Still very good, but that's the biggest monthly revision since 2014. Earnings were up a tenth on the month. No big contribution from minimum wage increases January 1st. On a year-over-year basis, they are up 3.2%, a very healthy number. Hours worked unchanged, 34.5. As for unemployment, the 175,000 federal workers reported being on temporary layoff, enough to push the federal worker unemployment rate up to 2.6% from 2.2%, and add that tick to the overall unemployment number. The U6 rate, which includes the discouraged workers, rises substantially to 8.1% from 7.6. Categories of job creation: 13,000 in manufacturing, 900 of those in primary metals, steel and aluminum manufacturing, 3,000 in metal fabrication, 52,000 construction jobs. Interestingly, construction pay dropped during the month by 0.4. No big holiday layoffs at retailers. Retail jobs rise by 21,000. Coal mining jobs fall by 100. And for those of you nerds out there who are missing your GDP figures, a proxy for that, aggregate weekly hours were up 0.3 to 110.9. Guys?
All right, Bloomberg's Michael McKee, hang tight for a second. So market reaction, dollar off the lows, but still not negative territory. A little bit of selling, picking up on the margin in the Treasury market, but again, not a lot of real movement happening. The curve continues to flatten in the U.S. Megan Green and Manulife Asset Management still with us. You're a nerd, so here's your take.
I am. I mean, what government shutdown and what bad weather. I think this is a blockbuster jobs report, both in terms of average hourly earnings and, as Mike pointed out, in terms of hours worked. So for all the concerns about underlying weakness in the economy, of which, there aren't that many signs of in the hard data, I think this suggests, that's right. The economy is actually still strong. It'll be interesting to see what the Fed does off the back of this. And of course, the Fed has time, but, for all the worries that the Fed won't be hiking rates anymore, and that it's data dependent, I do think that there is an argument that the data will justify.
Yeah, it's an interesting question whether Mr. Powell would have said the same things the same way if he'd had these numbers beforehand.
Yeah, that's right. Exactly. And as Mike pointed out, construction, manufacturing, those are high wage, high hour jobs. And so the trend throughout this cycle has been that we're adding all our jobs in low wage, low hour sectors. And so that's why we haven't had wage growth. But this is bucking that trend a little bit.
And we keep adding these jobs and adding these jobs way past the point where we thought we were going to be exhausted. And the labor force participation rate is still inching higher, which might suggest there's even more excess capacity in terms of workers.
That's right. So I do think it means we might be able to pull some people in from the sidelines, and that's sort of the Fed's plan. It started under Janet Yellen, but I also think we need to rethink our definition or estimate of full employment, which the Fed has, to be fair, revised a couple of times, but I think that they're going to have to revise it again.
Hey, Mike, what about you?
Well, here's an interesting note. This is the month where they do the annual benchmarking. They compare the numbers they've estimated over the past year to actual figures from unemployment filings, and they have lowered the civilian labor force by more than 500,000. So you can't really compare the December and January numbers as you would any other 2 months, but it does suggest an even tighter labor market in the sense that there are fewer workers available to come back in. So the fact that we still continue to create that number of jobs remains impressive. This is the 100th month in a row of job creation, a record.
Yeah, and Mike, I want to come back to that revision issue because some people are saying watch it because there was a sharp downward revision. As you said, Mike, in last month's numbers, although I quickly worked on my calculator, I think if you take the first reported number from last month, and put it together with the estimated here and compare it with the actuals and the revised, we're still up. It's a bigger number. I mean, the number we came down last month is not big enough to offset the month in which we've exceeded what it was expected this month. So it's still positive.
Yeah, it's all very complicated, David, and the tinfoil hat crowd sometimes gets exercised by this, thinking there's some sort of manipulation, but basically what we're doing is substituting estimated data for actual data, and it does show changes. However, the changes for 2018 so far are very, very minor, the lowest since the 1980s, so nothing really in that. And the November numbers, they haven't even been changed yet because they're still working on those figures, so nothing to see here is basically the case. It's just hard to compare a month-over-month change from 2018 to 2019 now.
Yeah. The 3-month average is 241,000 jobs, which at this stage in the cycle is really robust.
Pretty extraordinary. Okay, we welcome now from New Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, and he is Ira Jersey. Ira, you've had a chance to look at these numbers briefly, at least with us. Let's answer the question that Megan posed, which is, what does this mean for the Fed?